Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. Today we're going to be talking about IPOs, initial public offerings. With the Facebook IPO coming down the pike next week, IPOs are front and center, and I thought that might be an interesting topic to cover this week, what an IPO is, what the process is, and some really interesting facts about the Facebook IPO. But before we get to that, I'd like to talk about what's moving the markets this week and going into next week. Front and center, of course, is the Eurozone. It's back in focus again. The elections over the weekend in France and in Greece definitely sparked initial fears. Again, European markets have fallen significantly. The euro currency has fallen relative to the US dollar. And the fear now is very similar to what it was 6 months ago, a year ago, is that we're not only going to be concerned about Greece, but also about the debt situation in Portugal, Spain, Italy, Ireland, the potential restructurings in each of these, and because of these elections and the outcomes of these elections, the fact that the restructuring is probably going to take a very, very long time with the resulting political leaders that are in place now. So there's not going to be a quick solution to this problem. We definitely anticipate that we're going to be seeing this in the market for a long time. So that's number one. Number two is really just more of an interesting observation. Over the last week, as we saw the markets decline, at this point it's about 400 points or so over the last 6 trading days, we also saw gold decline. And right now gold is off approximately 10% or so from its high. Those are usually two things that you don't see going together. Typically, when the market is going down, gold as a commodity, the value of gold is going up because gold is typically perceived to be the fear trade. It's the safe haven. It's the place that people go when they don't know where else to go when the markets are declining. But gold is also a hedge against inflation. Commodities in general are typically a hedge against inflation. Oil, any of the precious metals, etc., they're all hedges against inflation. The idea being if you invest in a commodity and inflation goes up and the cost of those commodities go up, then you're going to be able to keep pace with inflation. So this decline in gold is really more of a commentary on the expectation that inflation is not going to, inflation and also growth are not going to be strong or are starting to slow over the coming quarters. And that I think is really what this decline in gold coupled with the decline in the market is telling us. We had been expecting inflation and growth somewhere in the neighborhood of about 3.4, 3.5% for the year, annualized for the year. That's what it looked like in the first quarter. Now we're seeing that number really going back towards about 2%. So I think that the commentary that the gold trade is showing us is that growth is slowing, definitely beginning to slow, coming into the second and third quarters. So another interesting observation, still maintaining those treasury rates very, very low. They're very compressed. The 10-year treasury dropped well below 2% again the other day, starting to edge back up again a little bit. But it's just showing that the U.S. is still the safest place to go. The flight to quality is the flight to U.S. Treasuries. And another interesting thing to think about there is who is throwing money into U.S. Treasuries right now, because I think a lot of people are concerned about the bubble in Treasuries, something that we hear about all the time. But you still have pension funds, insurance companies, and a lot of investors who have to have yield. And right now there are just very few low-risk choices when they're looking for yield. So pension funds, insurance companies, baby boomers, investors that are looking for yield are going to be looking to put money back into treasuries. And those are some of the factors that have driven those treasury yields back down below 2%, again, well below 2% at one point. So that's another interesting observation. And just in general, it does look like we're again just sort of kicking that can down the road. I almost hate that phrase because we heard it over and over again back last fall. But that really does appear to be what's happening again. We have an election year here in the U.S., probably the lame duck Congress session, et cetera. Very little will probably happen there. We're on the edge of this fiscal cliff that's going to come in 2013. Anticipated increases in tax rates are creating a lot of uncertainty among managers. This restructuring in Europe is probably going to take a long time. It's not going to be a quick fix. So there's just a lot going on right now that's going to be very slow moving, and I think we're just seeing this kicking the can down the road. I know last week we talked about the market sort of coming to a point and just sort of moving sideways. It still seems to be going in that direction, and basically what that tells me is that there are going to be opportunities for buying value in this kind of a market. It's not going to be a telltale, it's not going to be quick, but that there are going to be opportunities to seek out value, especially when we have big moving days in the market as we've seen over the last week. But it's basically just going to be sort of a long haul for the next several quarters, we would anticipate. So that's pretty much what's moving the markets what's moving the market this week going into next week. We'll be right back in a second to talk about IPOs, the Facebook IPO, so please come back and join us. This is Money Matters.
Hello, this is David Kroll. I'm from Mortgage Network, and this is the Mortgage Minute. I want to draw attention this week to further strange developments in international finance. Doesn't sound like it has much to do with mortgages, but it does. Europe is facing a deepening recession. It is now clear that recessionary trend is going to continue and grow deeper. There are now 5 European heads of state who have been toppled because of uprising in the electorate over belt tightening. The European mess is not going to get better anytime soon. Result, unexpectedly, rates here in the United States will continue to be at record lows and may even go lower. Now is the time to step into the finance market if you are borrowing money for any purpose whatsoever, even to refinance your existing mortgage. Step into the market, call your mortgage banker or your banker and say, get me a mortgage. The rates are going to be the lowest that they've ever been. Thank you.
Welcome back to Money Matters. With the Facebook IPO coming down the pike next week, I thought that it would be timely to talk about what an IPO is. A lot of people think about IPOs, initial public offerings, as hearkening back to the tech boom of the late 1990s when we used to hear so much about technology companies going public at astronomical valuations. But IPOs have actually been going strong for years, 25 plus years, and certainly notably recently we've had several big names of companies go public, such as LinkedIn, Zynga, Carlyle, Zillow, the real estate company, Groupon, of course. So we've had a lot of large IPOs recently, but Facebook is potentially going to be the biggest internet IPO ever. So in light of that, let's talk about what an IPO is. IPO's initial public offering is when a private company becomes publicly traded on a stock exchange. Typically, they become publicly traded in order to raise capital for growth. So they sell their shares to the public so that they can raise additional capital to continue to grow the company. For initial investors as well, sometimes the motivation is going to be to cash out of their investment through an IPO. But typically, the most motivation comes from the desire to raise cash to continue to grow the company. And as I said, IPOs have been going strong for a long time here. As we can see, they certainly were strong during the strong years of the market, 2004 through 2007. We saw approximately 250 to 300 IPOs per year. During the recession years, 08 and 09, that dropped to about a third. And it's been going strong, though, again, from 2010 through 2012. Here we are only in May. We're obviously a little bit slower this year than we have been in the past 2 years, but you can see that it's definitely cyclical. And the reason for that is because IPOs are really based on demand, shareholder demand. A company is not going to go public unless they feel that the demand is going to be there for their shares. They don't want to go through the very long and cumbersome process of an IPO unless they know that the demand is going to be there and they're going to be able to raise the appropriate capital that they need. So what is the process of an IPO, this long and cumbersome process? Typically what happens is that a company first is going to engage an investment bank, maybe one or more, to consult on whether or not an IPO is a good idea. If they decide it is, then they go ahead and register with the SEC. The SEC vets the offering, which can take from weeks to months. It just depends on the kind of offering and how much the SEC needs to parse through their information. The reason that they do that is because the SEC wants to make sure that investors are not being cheated or taken advantage of, that all the information that's being presented to investors is accurate. Once that happens, the bankers then begin to gauge demand for the offering by what's called building a book. And this typically occurs during the quiet period while the company is being vetted by the SEC and slightly after. The bankers go out and they say, okay, in this case, Facebook is going to be coming to market. How many shares do you want and at what price would you be willing to buy them? So it's almost like an auction in a way at that time. And nothing is firmed in at that point. It's just merely building the demand, building a book, getting a gauge for what that future valuation potentially should be. Next, you're going to have managers and bankers that are going to host a teach-in for analysts, and then they're going to go on the road show, which is where they're out wooing all of the investors and the bankers, again trying to drum up more demand. That's what's happening with Facebook right now. And during that time is also when they're starting to get a better gauge on what the value per share is going to be. The actual valuation, though, occurs at a specific point in time, and that's just before the company goes to market. The value of Facebook is going to be released next week, the 17th, 18th of May, and that's when we'll have an absolute valuation per share for Facebook. So that's the next step, and then at that point, the company goes to market. So you'll see Mark Zuckerberg ringing the bell down at the bottom of the exchange on the day that the company goes public. So the next big question is going to be, how is the value going to be determined? Obviously, there are a lot of factors. Some are quantitative, some are qualitative. Number one is going to be timing. Timing is absolutely paramount. Demand is paramount. Is the market strong? Is the economy strong? Is the desire to take risk going to be strong? Right now, we have a little bit of concern over Europe, but really the demand around Facebook seems to be very strong because of the following that they have. In 1999, for example, during the tech boom, there were 117 IPOs that came out and actually doubled in value in the first day. In 2000, there were 77 companies that came out and doubled in value in the first day. We haven't seen that happen in quite some time. The last one where that happened was actually Baidu, the Chinese company, in 2005. But that's certainly something that can happen. So timing and demand are big drivers of what the valuation is going to be. Next thing that they look at, of course, is going to be the company's fundamentals, their cash flows, their balance sheet, what's their profitability, future growth, pro formas, projections, et cetera. Going to look at industry comparables. You're going to look at intangibles, such as what are the technologies that the company can produce, et cetera. And then, of course, it's going to be marketability. It's, again, going to be driven by timing and other intangibles in the marketplace. As we look here, we saw a lot of strength earlier in the year. We've seen IPOs start to die down slightly, but we're continuing to see that come up. One thing that I want to talk about before we get to the Facebook IPO in particular is just going to be the risks of IPOs. Of course, you don't want to get hooked on headlines when it comes to IPOs. Oftentimes they come to market because they're based on the strength of the market. People are looking for opportunities right now, so don't get caught up just in the hype. Make sure that you focus on the fundamentals now. Be careful not to overpay because you like the company, because of the headlines. Typically, in general, IPOs have actually underperformed have underperformed over the first 5 years that they're actually public relative to their peers that are approximately the same size. So that's something to consider. And obviously, buyer beware. Make sure that the information that you have on hand is the correct information. And lastly, just make sure that it fits into your portfolio. So those are some of the risks of IPOs, the general basics of IPOs. In just a second, we'll be right back to discuss specifics of the Facebook IPO, the most exciting thing probably that's going to be on the market next week. So please join us. We'll be right back with Money Matters. Welcome back to Money Matters. Now let's cover the topic of the hour, the Facebook IPO. We've talked about what an IPO is, the process of an IPO, how stock shares are valued in an initial public offering, but let's talk about the specifics of the Facebook IPO. So Facebook filed with the SEC on February the 1st. They were in their quiet period. They recently came out of their quiet period. Now they're on their road show. The stock is expected to price next week, the 17th or 18th of May, and they're looking to raise somewhere between $5 billion and $10 billion, depending on who you talk to. So now let's talk about some of the factors that are going to impact this valuation. Number one, of course, as we talked about previously, is the financials, the revenue. So the revenue of Facebook, while it's strong, has actually been declining, especially in advertising revenues. It's been declining over the last quarter or so. Facebook management right now is saying that they feel that that's really due to seasonality, other factors in the economy, but that's definitely something that's probably going to weigh in to the valuation of this stock. Another thing to think about is just the qualitative evidence. They have a significant user base, 900 million plus users. They also have a huge quantity of data, and it's a very, very sticky application, meaning that people go to Facebook and they spend hours on Facebook. What this does is it provides a lot of opportunities for Facebook innovation. Facebook could come up with new services, new products, different sources of revenue. So if you're looking at projections, at Facebook projections, Facebook really does appear to have a lot of opportunity on the horizon for growth. And on the low end, actually, analysts who've looked at the recent filings put their expected growth of Facebook for the next quarter at about 45%. Some analysts are edging that more towards 75%, but on the conservative side, they're looking at Facebook growth in somewhere in the neighborhood of about 45%, Facebook revenue growth. That's not necessarily share growth, so let's make sure we keep those two things separate. So this is obviously a very hotly debated topic. The Facebook bankers and Facebook management are obviously going to be trying to push that higher and higher. Now when they're out on their roadshow and they're talking to more bankers, more investors, and additional analysts, they're going to be trying to support their valuation at the higher end of this range, whereas you're also going to have other analysts that are out there looking to poke holes in that valuation and try to keep the share price of Facebook priced on the lower end. So one other interesting thing to talk about when it comes to the Facebook IPO is that really only a small percent of Facebook stock is going to be offered to the public. That's because, and that's the range is about 20 to 25% of the company's stock. That amount is called it's the float that's going to be offered to the general public. The rest of it is going to be retained by initial investors and by management. So really only a small portion of the company, somewhere around a quarter, is actually going to be owned by the retail public. The rest is still going to be owned by management, by the initial investors. So that's something that's not really discussed all that frequently, but it's still somewhat interesting. So getting back to the Facebook Roadshow, at the moment, Facebook's out of their quiet period. They're in the process of wooing investors. They're on their roadshows. The bankers are contacting investors to gauge interest in the number of shares that those investors are looking for and at what price they'd be interested in purchasing those shares. This is a process called building a book. Basically, the bankers call their various clients and they say, how many shares would you like and at what price? It's kind of like a backwards auction in a way. They're building their book. They're looking at what kind of demand they're actually able to build. So with something like Facebook, obviously, demand is not going to be an issue. The big challenge here is going to be making sure that all of the highest revenue generating clients are kept happy. So if you are an underwriter for a company like Facebook, for an IPO like Facebook, you're going to have a lot of clients that are clamoring for that particular stock. I know we have a lot of clients calling us. Probably pretty much every stock shop on the street has people calling them to find out about Facebook. So there's obviously a lot of demand. But how are those shares actually allocated? That's going to be determined by the bankers and the underwriters. And the bankers right now are going to be looking at their highest revenue generating clients and how they're going to keep those highest revenue generating clients happy. So there's a lot of bankers and a lot of investors right now jockeying for those allocations. So there's going to be very few, actual clients that are going to be able to benefit from the get-go by those shares at its IPO price. But one thing that's really interesting about the way that Facebook has approached this, and I think they're doing this obviously because they're one of the biggest social media companies, they have a very retail-centric market, and they want to make sure that they maintain that retail appeal, is that they're not just using the largest banks and the largest investment banks to allocate those shares. They actually are using 31 different banks to syndicate these shares, and only 19 of those are in the top 50. So what that's saying is they're using a lot of smaller, more boutique-y type banks, some actually minority-owned brokerages, women-owned brokerages. They're really trying to cater to that market as well, so that they're appealing to the retail public and keeping that image for themselves. So it's interesting to see how they're approaching their IPO differently than, say, Carlisle Properties did here recently, where they really just stuck to the top underwriting banks. So they're trying to cater to that retail public. It's just a really interesting challenge to see how Facebook is trying to manage its image and balance the world of high finance and the high IPO finance world with its retail public. Is somewhat interesting as well is that a lot of analysts are comparing the Facebook IPO to the Google IPO. Up to now, Google has actually been the largest internet IPO, and it raised about 1.6, 1.7 billion. Facebook, by comparison, is hoping to raise somewhere between 5 and 11.8 billion. So we're talking magnitudes of difference here, and they're apt comparisons because Google, at the time that it went public, was about the same size revenue-wise as Facebook is. Facebook's 8 years old. Google was 5 years old when it went public. Growth in both companies was starting to slow a little bit as they went into the IPO. They both have a significant number of users, a lot of stickiness, are credited with having a lot of innovation. So they're very apt comparisons, and it's interesting to look at that now because obviously Google was a high flyer after it went public, and it's had some challenges over the last couple of years. So obviously, many other internet companies are watching this IPO to try to gauge the markets. Obviously, demand is usually a big issue. Is there going to be enough demand? There's plenty of demand for Facebook, even in light of what's happening in Europe and Europe's impact on the markets and the slowing in markets, slowing in growth, slowing in economic activity, et cetera. Those aspects are seeming to take a back seat to the perceived opportunity that is the Facebook offering. So it's going to be really exciting to watch what happens over the next week. Hopefully it's going to be exciting for all the right reasons in the strength of the Facebook offering, but it'll be interesting to see how it fares in light of what's going on in Europe, and also just that it's the largest IPO, could be the largest internet IPO of all time. So that's pretty much it as far as the Facebook IPO goes. If you have any questions about it, please give me a call. Would love to talk about it in more detail. Love to hear your opinions on it. We will be right back in just a second with our parting shots from Money Matters. Welcome back to Money Matters. Just two quick parting shots for the week. Number one, be looking for opportunities to buy into value. Those opportunities are presenting themselves now in this market. Situation in Europe and other headlines are driving the markets in different directions. It's not necessarily indicative of companies' balance sheets and where they're going. So take a look at the companies that you feel are a good value and look for the opportunity to purchase those over the coming quarters. That's number one. Number two, take a look at the Facebook IPO. See how it might fit into your portfolio. There's a lot of different opinions out there about it. Certainly it's not right for everybody, and it should not be looked at in a vacuum. You should look at it in light of your entire portfolio. But take a look at it. I think it's an interesting exercise. So that's pretty much it for the week. Thank you so much for joining us. If you have any questions, any commentary, please give us a call, shoot us an email, check us out on Facebook. Send me ideas for future shows. I love hearing from you. So thank you so much for joining us, and we look forward to seeing you here again next week on Money Matters. Have a great week.